If you lived through the Great Depression with a balanced portfolio, you lost as much as 72%. And at the end of it all, you were down still over 60% after 13 years. And you think you're still going to have a client paying fees for that. So the thing that one needs to do with behavioral finance is start with a portfolio. You need to build a portfolio that's designed to address both the economic and psychological needs of investors, which leads to your question about how do you manage behavior around that. The entire second half of the book talks about a proactive construct that we worked with through our Behavioral Investing Institute, which is a department of our asset management firm. We've done a lot of coaching, consulting over the years with advisors. What that does is it builds an entire proactive communications construct around how to talk about the markets. You don't shy away from big down markets. You want to actually focus on how bad down markets can get. But then the very next thing is you talk about how the portfolio is designed to address it. And then you talk about what actions you're going to take when you have these big down markets. And so then you've got something called an investment owner's manual. You walk through different investment challenges, how the portfolio is designed to address it, how you do that. And so it is important because if all you do, you're exactly right. If all you do is you execute this portfolio that we've been talking about and you don't attach the consulting around it, the messaging around it, after a couple of years, investors are kind of like, look, this thing's underperforming. Can we please just leave it and go into Mag 7 or whatever else happens to be doing very well? So both parts are really important, both the portfolio part and the consulting part.